Development Partners. Oh, I'm sorry, Davon. Um, and our focus at Genesis Development is retail real estate development. I started the company back in 2021, and I have been in commercial real estate. I started with my first real estate deal at the age of 19, where I purchased my first investment property. And from there, went and got a master's of commercial real estate at the University of Georgia at the Terry MBA program. And then started my career at CB Richard Ellis, which is a large commercial brokerage firm. You can come down, which is a large commercial brokerage firm. There, I focused on retail real estate, working with retailers as they expand in the Southeast. So you guys go out, you see, shopping centers and things like that. There are people who literally go and negotiate those deals, the rents, the terms, et cetera. That is what I did for a long time. I did that for about 10 years and then started a business with my then husband that he had a really cool recipe. Shout out to Joe of Joe's Gourmet. And we took that recipe from the kitchen idea to over $1 million a year in sales. And in 2021, after having that really, really fun ride with Joe's Gourmet, I started this company, Genesis Development Partners. And tonight we'll start, I'll take you guys through a deal that we're currently doing. I'm gonna kind of like take you behind the scenes so you can kind of see how the deal was put together and sort of the evolution that we've taken with the deal over the last 18 months. So that's kind of the rundown on who I am and what we're doing here. This webinar is sponsored by Vestor. Vestor is an equity crowdfunding platform. Vestor was started by Davon Reeves. She's going to join us a little bit later. But she has raised millions of dollars for the purpose of opening hotels. She and her investor partners own 3 hotels. Currently, she is the GOAT as it relates to raising capital. And so her and her company are sponsoring this webinar for you guys tonight so that you can learn more about this particular category, which is retail. All right, so I do have a project on Vestor right now. I'm actually going to talk about it a little bit tonight. We're going to use it as our case study for you guys to go in and understand the numbers behind this type of deal. And then we're going to take a lot of questions because I'm going to just throw like a lot of information at you guys. Just kind of a warning, go ahead and get your calculator. Curtis Freeman. Boy, don't play with me. I be done put you up in here with me. Curtis Fralin is another wonderful Black developer who's he's gonna hate that I'm shouting him out probably, but he was one person I've looked up to for many years for what he's done in the industry. But anyways, so get your calculators, guys. We're gonna walk through a deal. And I want the best way for you to understand it is for you to do it right along with me. All right. So let's back up through last night, where we talked about, let me find that presentation from last night, where we talked about kind of what is retail real estate and the different types. For y'all who were here last night, I'll try to just zip through it very, very quickly, just so the people tonight aren't lost, right? All right. Let's see. Okay. All right. All right. So here we go. Last night, guys, we talked about the different types of real estate. Most of you are familiar with residential real estate, which includes homes, townhomes, and condos. This is what most people are aware of. This is most of you either live in one of these or own one. And then there's another category called commercial real estate. Commercial real estate is typically very specialized. Here you have office buildings, industrial, retail. I didn't put this on here, but you also have multifamily. And of course, Davon's favorite, which is hotels. So those are the different facets of commercial real estate. You have office properties, retail properties, industrial, and then you also have mixed use, transit oriented. Mixed use, sometimes you'll see where there are people working and living in the same area, or you'll see people who are shopping and living in an area. Is usually the combination you see the most. Retail real estate, what is it? It is one of the largest, most diverse categories within the commercial real estate sector. It holds approximately 25% of the total real estate market share. Over the past decade, the industry has increased 4 to 5% in annual growth. And as a side note, the leases are typically 5 to 10 years and derive their value from the rent of the tenant. They derive their value from the rent of the tenants. I repeated that because that's what we're going to focus on tonight, is the fact that commercial real estate is income driven and it is based on pretty set market standards. It is not subject to opinion or value in the eye of the beholder as residential is. Okay, so we're going to get into that and what does that look like and how do you calculate it. All right. What are the types of centers and retail? There are malls. We talked about this last night. Of course, y'all know what a mall is. How we categorize it is based on the distance that you drive, how big it is, and the approximate size and the number of tenants, and the fact that it's enclosed. All of those things make up a mall. You're seeing malls lose a lot of retailers. They're losing sales per square foot right now. The taste of the market is changing. So if you walk into a mall, you might feel like, okay, retail's not growing, it's shrinking. But we're going to get into, you have certain areas that are growing within retail and some areas that are struggling. Malls is one of them. Lifestyle centers, you guys probably seen this in most of your areas. For all my people in Kansas, Kansas was actually one of the first lifestyle centers. That one right there in Wichita, Kansas was one of the first ones. I forgot the name of it. But that is typically outdoor, centered around dining and entertainment. You'll a lot of times have like a movie theater and then some high-end shops. And that is kind of like, thank you, Bradley Fair. Thank you. That was one of the first lifestyle centers created. So anyway, so that is a lifestyle center. Then you have power centers. This is what you typically see every day. It's going to have the same characters. It's going to have Kohl's, TJ Maxx. Sometimes it'll be anchored by a larger, super big box like Home Depot, Lowe's, or Walmart or Target. You'll see these typically be leased to discounters, home improvement. The trade area for that is 5 to 10 miles. And when I say trade area, that basically just describes how far people will drive to get there. So, I may drive 5 to 10 miles to get to a TJ Maxx, but I more than likely would not drive that far to get my Starbucks, or I wouldn't drive that far to get my prescription, or I wouldn't drive that far to go to the grocery store. So these next categories are my favorite. These next two are the ones that are growing the most. These next two are where the opportunity is. So neighborhood centers. Neighborhood centers is typically grocery anchored. It may not be, right? But they're usually a little bit larger than a convenience oriented center. They range from 30,000 to 125,000. Most of you have one of these within 3 miles of your house. The reason why this category is growing is because people are moving to larger metros. So most of your major cities are seeing anywhere from 3 to 7% annual growth. especially when you get into the Southeast. Here in Atlanta, I think ours is about 6.5. Florida, the Carolinas, Texas, all these areas are experiencing population growth, which is creating new trade areas. So you guys see this. Sometimes you'll go out in an area that used to be all farmland, and now all of a sudden there are subdivisions built up. All of those areas, new trade areas that are being created, will require neighborhood, or they won't require it. It's an opportunity for us to make money by bringing neighborhood and convenience-oriented centers. All right, convenience-oriented center, small non-anchor center. This is my favorite. This is what we rock with right here. It's usually centered on goods and services in the immediate area. The reason why we like these is they're smaller in scale. They typically have lower vacancy. They typically will pay higher rents per square foot. One note to make about this, you can pass your operating taxes and insurance costs onto the tenant. So operating expenses would be like your parking lot, your lights in the parking lot, the snow removal, pressure washing, all the things that you would need to do to the shopping center to keep it looking like an A+ shopping center. You can pass those expenses along with the insurance and taxes onto the tenant. Your tenants often have long-term leases, which provides you a stability for cash flow. Now, I know I'm running through this really, really fast. Last night we went through and explained it, but I got somewhere else I'm trying to go tonight, so we moving fast. If you have questions, drop them in the chat, because I know it's a lot, okay? All right, and so next, this is basically our process. This is how we preserve capital and work with our investors to make sure that they get a return. The first thing that we do is we identify the site. Now, the way I work, I usually work, and myself and Curtis, and I don't know who else from the industry is on here. One of the first things that we will do is we will identify a few tenants that are neighborhood or convenience-oriented tenants. And based on those long-term relationships, we will then identify areas that they want to go in. And then me personally, I will begin to look for a site. How do you pull this off if you haven't been in commercial real estate since the early 2000s like me? You built the right team, right? So you want to find a broker who is in that world. It's all about relationships, who can help you identify a retailer and then help you identify areas that they want to be in, and then you want to start looking for sites, okay? The next thing that we do is we'll gain site control. So just like how you put earnest money down on a house to let people know, I'm serious about buying this house, we will do the same thing for a piece of commercial property. The only difference is, instead of you having a couple weeks to 30 days, I usually like to try to tie my sites up for at least 8 to 12 months. The case study we're going to go through tonight, I actually had that one tied up for about 14 months before we closed. Okay. So everything is negotiable. Like throughout what we're talking about tonight, that is the main factor. Everything is negotiable, right? So typically during this time, we're doing due diligence. This is when you start spending money. First of all, you have to put the money up for your earnest money. Then secondly, you have to start your process of making sure that you can actually build what you want to build there by working with the city. Zoning, entitlements is a word that you use to just kind of comprise all of those things that you have to do with the city. So there's more than just zoning. There's environmental issues that you have to look at. You got to make sure that the dirt is solid enough for you to build what you want to build on. It's like a whole host of things, and that will be a whole nother class, right? The next thing that I like to do, once I have that understanding that I can build, that the numbers do work, and that the client likes the property, I will submit the site plans and all of that due diligence. Well, not necessarily the due diligence, but I'll just give the client the assurance that, hey, we could do your store here, right? And from there, they will take it through their internal process and get to this box here, which is full corporate approval. So I can look at something and say, I like it. If I'm a Fortune 500 company, I can't do it like that. I have to go through a process, which is usually like a committee of people in my company that will look at all the factors of that particular site. They'll look at things like, where's our other closest store? And how many sales are we doing in that store? And how far is it? Will we have cannibalism, or will we take sales away from that one by putting this one here? Is it is the visibility good? Can people get in and out of it relatively quickly? Where are our competitors, and who are our co-tenants? Those are all things that they look at. Once the corporate lease is signed, that's where the value is created. So you've taken a piece of property that's worth whatever the land value is. Once you have that corporate lease signed, you have now officially increased the value of that property. All right. So I think we're kind of caught up from last night. The reasons why I like to invest in shopping centers, like I said earlier, they are typically more than 5 years. I've seen them trend up lately. And Keisha, you can probably chime in on this. Curtis, you can chime on this. But the last couple deals I've been working with have been 10-year deals, whereas, before everything was skewed towards 5. A lot of it has to do with construction costs being up, interest rates being higher. It's like you just have to have more time and more rent to make the numbers work. Okay, I see your hand. I'll get Adora. I'll call on you in 1 sec. And then national credit tenants make the center valuable. And the reason why I say that the national credit tenants, ground leases. Yes. Yes, ground leases are typically 30 years or more. Our McDonald's ground lease is 20 years, but we'll talk about that. Oh, it's okay, Adora. All right. But yeah, so yeah, Curtis is pointing out that ground leases tend to be a lot longer because and we'll talk about what is a ground lease and how it works. And yes, longer term means less risk. All right, and so national credit tenants, you guys. So if you had me owe you $100 versus McDonald's owe you $100, which one would you prefer? Even though I'm good for it, I'm gonna give it back to you. The fact that McDonald's has something that you could go after in the event that they didn't, the fact that they have a lot more to lose makes them owing you $100 a lot more valuable, right? Y'all understand what I'm saying? So when I say a national credit tenant, that's what I mean. And all of those factors determine the value of the real estate at the day for that reason, that intrinsic reason of knowing, hey, these people have more to lose. Therefore, if they say they're going to pay me, they're going to pay me. Keisha says we love credit tenants. Yes, we do, sis. We do. So tenants pay all expenses. We talked about that. And shopping centers are relatively inexpensive to operate. Once they're up and running, like I said, you're passing through your expenses to the tenant. Your main focus is making sure that you stay occupied at the rents that you projected. Because again, the value of the shopping center is based on the rents that you're collecting. And we'll get into that a little bit more later on tonight. And there are a lot of buyers for shopping centers, believe it or not. Exiting a shopping center with national credit tenants, I mean, it varies. There's factors that increase the market versus increase demand versus less demand. And some of those factors include interest rate. Right now, we're in a very interesting environment because the interest rates are higher. And there's a relationship between cap rates, which what you'll learn about later tonight, and interest rates that kind of impact the demand of a shopping center. But overall, based on the cap rate, shopping centers, especially the smaller ones, especially, 10 million and less, there's a lot of buyers for it and there's a lot of demand. Why? If I am a person with $10 million in my family estate and I'm looking to get a return, 9 times out of 10, I can get a great return in real estate. It's something I can touch. It's something I'm comfortable with. That might be something I want to have over stocks or bonds or anything like that for those reasons. The next reason why I may want to have my money in real estate is because I'm going to get my return on the rents, but I'm also going to get a return in the increased value of the asset. For the most part, real estate increases in value over time. So people will invest in shopping centers or single tenant deals because they are able to kind of get that backdoor increase in value from the real estate itself that they may not get from just doing stocks, bonds, 401ks, all that kind of stuff. Are y'all with me? Okay, let me move on to tonight's presentation, day 2. Let me make sure y'all can see this screen. Okay, day 2. We're gonna just jump into a case study. But before I do that, do we have any questions so far? That was a whole lot. So do you guys have any questions before I move to the next section? Okay, let's go. Let's do this. All right, so last night we talked about the deal that I'm working on. Curtis has seen this deal. I don't think Keisha has seen it. Let me see who else is in here from the industry. Hey, Deidre, good to see you back tonight. Is there anybody else? Because y'all know I will call on y'all. Hey, Melissa. Melissa's in the house. Marissa is in the house. She is a commercial broker out of Ohio. Nate is here. Okay, because I got y'all in here because I'm going to call on y'all, just so you know, so y'all have my back, all you real estate people. Okay, so we're going to break down this deal and we're going to break down the numbers. And the point is so that you can really understand kind of my perspective, what I saw and why I put this property under contract and what the exit is. Okay, so as we talked about, let me go here. This property is in Kingstown Road, North Kingstown, Rhode Island, which is in New England. We purchased the property about a year ago, and we own from here, Devil's Foot Road, all the way to Duncan. When I say I purchased it a year ago, I basically mean myself and my investors. What's up? What is Deidre saying? Can y'all see my slide? Okay, y'all can see it. Okay. So anyway, so you have it from Devil's Foot Road all the way to Duncan. And so what I did is I had the property under contract and went and got this 20-year McDonald's lease and started putting my tenants together, just like I'm telling you guys to do or to look at doing. And then I went and found some investors who put up $3.5 million for me to purchase the property. We purchased the property at 2.5 million, and I'll break down these numbers. And then they raised an additional $1 million for us to do site work, which is what we are doing right now, right? I found this property. Actually, I was looking for another tenant, not McDonald's. and just thought it was a really great site. Why did I think it was a really great site? We talked about this last night. Visibility from the road, the fact that you can easily see these tenants from the road, the access, the fact that you can easily get to it. You can get to it off of Post Road, Devil's Foot, or Namcook. And so Route 1, this Post Road here, connects Rhode Island through Wickford, Tiverton, will even connect you to Fall River, Massachusetts, where you've got some industry. So this is a very heavily traveled road with a lot of traffic counts. If I am selling sandwiches like McDonald's, I want people who live in this area to come and buy my sandwiches. But I also want someone who wasn't even thinking about buying a sandwich to just drive by and come in. I could get, 10, 20% more sales if I'm on a road with a lot of traffic counts for impulse buying, right? There's also a thing where retailers like to be on one side of the road or the other. So they have this thing called the going to work side of the road and the coming home side of the road. So if I am selling coffee or donuts, or I'm a bank or something like that, I may want to be on the going to work side of the road. And if I'm selling dinner or entertainment, I may want to be on the going home side of the road. So these are all things that retailers look at, and what you'll want to look at when you are identifying a site or working with your team to identify a site. If you have a Dunkin' Donuts, you probably don't want to put them on the going home side of the road and make it difficult for them to get in here at 5 o'clock or at 6 o'clock in the morning, right? They want their customers to be able to get to them very, very easily. And all the factors that determine that would be visibility, access, what they call ingress and egress, getting in and out easily, etc. Another thing that's super important is what other tenants are there. So you guys take a minute, think about your favorite shopping center. It probably eerily looks like the same shopping center you went to while you were on vacation. Probably had the same tenants in it. Why? Because they all like to kind of go together, right? They feel that there's more synergy. Like, for example, Kohl's and TJ Maxx would get more synergy because they're in this center together, right? Same thing when you're doing your deals. This is more of what we would call power center here. And then we are more of a neighborhood center, but we are like feeding off of the traffic that the power center is going to have. So that makes this site extremely desirable based on the other tenants that are in the market. Another thing that makes this desirable is back here, behind this Kohl's, where you see these buildings here, that is the beginning of Quonset Office Park. And they recently got a multi-billion-dollar deal to build planes there. So there's a huge government contract there and a lot of workers, a lot of people going to work every day. And those people going to work every day are going to want breakfast sandwiches. They're going to want to get their car washed. They're going to want tacos for lunch. All of those things help drive this site being a better site. Okay. Now back to the site itself. So Curtis brought up the 20-year ground lease. I mean, ground leases in general. That's what we have here with this McDonald's. So McDonald's has agreed to build their own building. What they are doing is they are renting our land from us, right? They have promised, okay, we're going to pay you $120,000 a year for the next 20 years so that we can build our building here and sell hamburgers. That's it. That's what a ground lease is. We like them because they're stable. And let's say at the end of 20 years, McDonald's decides they don't want to be here anymore. That's fine. We get to keep your building though, right? So they've added value there. Now, what's the likelihood of them spending millions of dollars and only staying there 20 years? It's not likely. They'll probably be there a very, very long time. That's what they're banking on. So that's why they would agree to do this type of deal in the first place. So we love, 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 love ground leases. They are like premium. If you can get a ground lease, that means you have less investment up front. And it means that you have long-term stable income, which also makes it very easy to sell, right? Because buyers will look at this as long-term stable income. And, typically your buyer is going to be a grandpa who's just looking for somewhere to put his money. He is wanting something super easy, and these are super attractive. Okay. So that's what we're doing in parcel B. Do you have to do this site work for the ground lease? Yes. So again, everything is negotiable, right? Everything is negotiable. But in this particular case, we negotiated to do not all the site work, but a large portion of the site work. This property did not have sewer. There is a sewer valve up here in this upper left corner. And so we went through the process of getting a sewer permit, and we will be bringing sewer to these 3 parcels. So that was one of the things that we agreed to do. We also agreed to make this what they call pad ready. And that basically means all utilities graded, and to make sure that the soil is fit for them to build their building. And that's it. That's how we delivered their pad, is what they call it, right? But everything is negotiable. We could have gotten less rent and just told them do it yourself, but they wouldn't have paid 120. They probably would have paid right around 70 or 80 for that. But again, everything is negotiable, and then you work your numbers to determine what works best for you and your investors. I hope that answered your question. So parcel B is the McDonald's. Parcel C here, this is a car wash. This Concept Gloss car wash. These are doing very well in the market. I'm sure, Curtis, you guys have a lot of activity with these in California. I don't know, because y'all regulations are kind of, I don't know. We'll talk about that. I'm curious how many car washes are moving out there. But this is a interesting concept because it has low operating costs, high margins. A lot of the concepts are automated. And so there's a lot of demand for car washes right now. This particular market doesn't have a competitor. It has another car wash, but it is not this automated type car wash. It's like a little car wash inside the gas station kind of thing. So we've been working with the city. They're doing a lot of residential in this market. So, they're interested in making sure, because of the residential that they're doing, because of the daytime population from this office building and the Quonset plant, that people have basic goods and services. So we are going to be able to get this permitted, but there will only be room for one, I think, within a 2-mile radius. So with car washes, you want to have typically a minimum of 20,000 people within a 2-mile and no competition. And then there's basically a formula that tells you how many cars per day you can do if you do that. In this particular case, we are putting a value to this piece of real estate. And this car wash is the deal that I'll be working with on Vestor. Even though my Vestor package allows us to do any one of these deals, it's basically a fund where we can invest in retail real estate. But I will be doing this deal with Vestor because it is simple. I'm just breaking it out from the rest of this package and doing it on there. Last night, I talked about why I'm doing Vestor. I don't necessarily need to raise $300,000 investor when I break down to you guys how the deal is structured and how the capital stack, which is what they call how the money lays out. We don't really need to raise additional capital. We don't. However, Vestor, which is owned by Davon Reeves, I think is very, 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 very important to our community, and I want to see it succeed. So I want to make sure that Vestor has high quality projects. So I am carving out a small piece and a small raise for the purposes of making sure that we have a platform like this. So like idealistically, when we're all sitting around and we're having conversation, we're like, why don't we pull our money together and do our own thing? Why are we depending on the system? Why are we trying to get jobs everywhere? It's an idealistic concept that Vester is actually made real, right? She has raised millions of dollars for funders or investors, developers like myself, or investors like some of the other hotel owners that she's worked with. And where else are these people going to go and raise a couple $1,000,000? When you put your deal together, how are you going to get your equity? You are going to call Davon and you're going to put your deal on Vester. You're going to get in these groups, and the other people who are in this group, you get to know them, and you guys get together and work and put together a deal, and you go to Vester and you raise your equity. It is very, very, very important to me that these type of platforms exist. So even if I do a tiny bit of my deal with Vester, then so be it. Most of my project is done with what they call accredited investors. In my case, my niche are doctors. I raised the money with about 36 Middle Eastern doctors, and they put in various amounts of money from 250 all the way up to $850,000. They pulled it together and handed me a check for $3.5 million to purchase this property. But you know, that's just from building the relationship with them over time. They have the money, they don't have the time. I have the time and I didn't have money. So we made an exchange, right? Um, and they are willing to put the money there and let me work and let it take time and do whatever we need to do, whereas a bank would necessarily do that for us. So anyway, that's kind of, and I'll kind of break down the capital stack in just a moment, but that is the reason why I'm doing a project Vester. It is more altruistic. It is more so that I can have opportunities to teach other people how to do this. And it is more to give people exposure. So if you were to work with me on a Vester project, that would give me an excuse to get on the phone with you guys every quarter and go through where we are with the deal. And hopefully as a vested person, you would really grasp the information and learn it, and then learn how to move forward in your deal and feel a little bit more confident. Once you make money in this area, then you just start where you are, right? And hopefully within our investor group, you'll build the relationship so you guys can work together and do things. So it's me being a little bit optimistic, altruistic, whatever you want to call it. But I wanted to carve out a small piece of my capital stack. In this case, it's $300,000 to allow people to participate, even at the minimal level of 5,000. Okay, so that's my spiel on that. So the deal that I'm going to be doing on Vester will be this car wash, which we are actually purchasing the land from the partnership, and we are funding this piece of the deal using an SBA loan. Okay. SBA loans are a great way to, because we're actually going to operate it. So I have an operator, which is one of my partners. And in our case, we won't operate it fully. We probably sell within a month of opening, right? So the reason why, and I'll get into that, is you need a lot less money down. Our construction cost on this is about $3.5 million, and the $300,000 that I am raising on Vester will be the equity for this deal. Okay. All right. Okay, so let's break down this deal at Kingstown, Rhode Island. Purchase price was $2.5 million. First capital raise was $3.5 million. $1 million of that $2.5 million were due diligence, site work costs, legal costs, all of that. So about $1 million for us to bring the sewer, do the site work, get everything prepared, and everything based on what we agreed to deliver to McDonald's and the other parcels. Okay, now we talked about value creation. How do you create value? In our case, we create value by adding leases and future rent to the land, or at least that's how my business model works. Okay, my business model is for now to exit. I build, create the value, and I'm out. Someday, because the reason why I'm out is because I have to pay all my people back. And then I keep the difference between what I pay my investors and what I take. And then I have capital to then maybe roll into something that I can hold long term. Does that make sense? But I'm not in that mode. There's a time and a season for everything. And me right now, I'm just all about creating value and exiting. So I'm probably about 10, 15 years behind Curtis. So he know about that life, right? All right. So the first property, which we saw, let's remind you, that's this one. This is 12,000 square feet that we are building. Right now we have East, which is Taco Bell. They want to take 2,700 square foot end cap. Right here we've got 4,500 square feet, and we are negotiating with Jersey Mike's. It will either be Jersey Mike's and Tropical Smoothie, because I don't want to do too much food. And the reason being is because food takes up more parking. So I really only want to have 2 food choices, even though I have interest from Jersey Mike's and Tropical. We'll probably pick one. Here on this end cap, I'm super stoked about this. We're negotiating with a medical user, so like a urgent care, who's wanting to pay some pretty great rents. But that deal's not done, so that's why I don't have it on here, but we are in full negotiations there. So the rest of the center will probably be, why not combine the 2 restaurants? What the 2, oh, you mean like with Tropical Smoothie? Okay, so Tropical Smoothie and Jersey Mike's, if you put both of them in there, you probably would create issues with parking. So you kind of want to balance your tenant mix with, some people who use heavy parking, some people who use light parking. Have you guys ever gone to a shopping center and you're like, damn, I'm not going there because every time I go there, I can't find a parking space. And so what'll happen is you'll stop going, your tenants will be upset because they're losing sales. So you got to think about those kind of things when you are planning it out. If I just put everybody in here and now my center becomes the one where nobody can park, if people aren't making money, they can't pay me my rent on time. So I think about all of that in the beginning. Like, we begin with the end in mind. So even though we have interest from IHOP, they wanted to take this parcel here. I think they'll just be too parking intensive. And so I would rather have non-food. So I want to do 2 food users, and then everything else we can fill in. I mean, there's probably going to be a nail salon or, something like that. As long as I've got the majority of my center with national credit tenants, which in this case, the 4,500 plus the 2,700, that will make me more than, Aspen Dental would be amazing. They went across the street though, Deirdre. But yes, that is the kind of the thought, like a medical type. But yeah, so there's a lot of interest here for urgent care to go there. But I have my broker looking at some of the cell phone users around. There's a Verizon across the street in the center. There's no AT&T, so ask them to either reach out to AT&T corporate or one of their large store franchisees to see if we could do cell phone there or something else that has kind of a light parking use, right? But you can take this deal to the bank once you have more than 60% leased. And so once we sign up this medical user, and either Tropical or Jersey Mike's will be good there. I had to get an approval from McDonald's to put Taco Bell there. Um, you don't always have to, but I made a mistake in not negotiating my lease up front properly to allow them to come in, because they came in after this deal was done and there was an exclusive. I should have had Curtis look at my lease or someone else to remind me of that. So when Taco Bell showed up, I had to go back and give a concession. I can't remember what I gave them. Something they wanted that I gave them so that they would release the exclusive. Let me do Taco Bell in there. So those are all things that you learn as you go. And you're gonna make mistakes. I bet y'all never make that mistake again, but that's kind of how you learn, unfortunately. That and having, good partners and people surrounding you to help you, right? But it worked out, and we have that Taco Bell lease signed, and we're working diligently to get the rest of the leases signed so that we can go and get financing for this particular deal. All right, so back to breakdown. It's 12,000 square feet. At an average of, I think I plugged in $48. That would make it a value of 8,307. And we're gonna come back and break down how I came up with that. And not 8,000, 8 million. We'll come back and break down how I came up with that $8. We plugged in a value of the land, because remember, we are the ones who own the land, so we determine what it's worth and the number that we plug in for the purposes of financing and putting the numbers together. So we plugged in $1.5 million for the land. And then it's going to cost us roughly $3.5 million to build the building. Keep in mind, we already had the site work done in the other. When we did the site work for McDonald's, we did the site work for the whole property. So that's literally just building. I think that's pretty conservative. Hopefully we come in less than that. But building cost is up, so I just put in a number that I thought, I know for sure we can get it done for this, right? So based on those numbers, the upside value that we create here is about $3.3 million. That's what you want to do, is create that upside value. Y'all with me? And this upside value is what I will split with my investor, right? The return that they will get. So I think the way my deal is structured, I think we split 50-50, and then there's like a premium that they get, like an incentive they get based on how long it takes me to get it done, something like that. All right. Then number 2 is the McDonald's. That breaks down the value of the McDonald's is $2,526,315. This is based on, for all of my real estate nerds in here, a 4.75% cap rate, which is not typical right now. Typically, your cap rates, and I'm going to explain to you guys what a cap rate is around 6%. But McDonald's has a lot of, there's just not that many McDonald's that trade, not many McDonald's ground leases, and not many at this size. Most of them are, over 3 to 5 million. So having a McDonald's in the Northeast of this size, based on my conversations with the brokers, is going to trade at about a 4.75, because it's a highly sought after type of tenant. Okay, so we'll talk about cap rates and how you come up with them. But the way that you would figure that out is you would talk to brokers who are trading deals every single day. So it looks like this. I'm like, okay, let me call somebody at CB Richard Ellis. Hey, I got this McDonald's. Let me send you a site plan. Can you send me some comps based on what McDonald's are trading at? Let me call CBRE. Let me call Marcus Millichap. Let me call all the big guys, and then I can come up with my number. And that's how I evaluate the value. Does that make sense? So that's how I came up with $2.5 million for the McDonald's. And then you subtract the $1 million that we put in for site work, and that makes the value created there $1.5 million, because remember, we don't have to build the building. So $1 million is what it cost us to deliver it at that. And so there's not a lot of upside on the McDonald's, as you can tell, because you probably would plug in $1 million number for the land, which is really giving you a true upside of about 500,000. But the McDonald's is driving other tenants to be there so we can make some money, right? And that's how a lot of anchor tenants are. It's like people will do a deal with like a Macy's, and Macy's will pay like nothing. But Macy's is the reason why a lot of other tenants are there, and they can make their money off of them. Does that make sense? And then the third property, which is the car wash, which is the one I'll put on Investor, is a little bit different because we're actually using an SBA loan. We're actually bringing in a operator, and we will purchase that property, build the building, set everything up. We will either exit at CO, which is basically, okay, the building is built and it's ready to go and someone can come and buy it. There are a lot of people buying these. We're working with a consultant right now who is setting up some pre-meetings. So we may pre-sell this, but based on her valuation, the minimum we would get, even if we pre-sold it, would be around 6 million. I put 6.5 because more than likely we'll go a little bit further down the process. I plugged in $1.2 million for the land, and it's going to cost us about $3.5 million to build the building, giving an upside of 1.75. Total sales on the property, I was flabbergasted that it ended up being this much because that's not what we planned on originally. Curtis, remember when I talked to you about this 2 years ago? What really drove the total sales up is the high rents that we're able to get on the 12,000 square foot strip on the corner. And so total sales on the property is going to be 17 million. A lot of that is land, the cost to build the buildings, everything we need to do to make that money, making our total value created or our total upside at $4.8 million, which we will then split with our investors. Now, the difference is here, actually you carve this out. And when I say our investors, that includes you as well. The difference is with property 3, we will carve that out and do a separate SBA loan. So the money that you put up will be the equity for that SBA loan. And then your value created is 1.7 here. All right. All right, so how do you, and I'm going to wrap this up because it's 8 o'clock already, man. How do you determine the value in commercial real estate? It is income driven. It's not, oh, I like the kitchen or I like the neighborhood. It is based on how much rent can be driven and how that rent equates to the rest of the market. So you use a standard measure determined by the market, which is called a cap rate. So when I was telling you guys, man, I'm on the phone calling people saying, what's the cap rate for McDonald's in New England? And they're telling me, hey, it's 4.75, or what's the cap rate for this size McDonald's, whatever. And then I take that number, and hopefully I put the calculation, yes. I take that number and divide my rent by the cap rate, and that's how I come up with the value, right? So you take the number, you divide it by the standard market rate that you have to do the research and find, and that's how you come up with your value. All right. So I want you guys to pull out, how did I convince McDonald's to? Oh, okay, yes. Oh, thanks. Yeah, because then I left the value for the corner. Okay, so Curtis is asking me, how do we convince McDonald's to not take the corner? Because they always want the corner, right? The reason why is because this corner was annoying. It has some challenges. If you see this line right here, y'all see that kind of curving right here? That is a utility easement, right? You cannot build a building underneath this utility easement. They did give us permission to park under it. And an easement is a right that someone has to use your property. Okay, so this is Rhode Island's power company, and for 100 years, they have had the right to this huge block of this property. You see how much of the other property that is? Huge chunk that now becomes unusable. In addition to that, I have a storm drain, a culvert right here that has to be moved, right? And so, Curtis, when they dug into this corner, they thought it was a headache and preferred to go here because this site was more site ready. So that's how it was. I just came up. It wasn't even that I was just willing to take on more challenges and try to do my center here to answer your question. Are these actual numbers or paper for the car wash property? So yes, these are actual numbers. And the way that we derive the numbers, Deirdre, is the same way I figured out the cap rate for the McDonald's. So we saw other, the only reason we're even doing a car wash is there was a national credit car wash called Hang 10 who had an offer on this property, and then they ran the numbers on what they projected this would do. And then they decided, hey, we want to put all our development on hold for a year. But this is something we really want to do. So, but I don't want to wait a year because I got these people money, Deirdre, and I'm trying to pay them back. So based on that, we brought in some car wash consultants to verify their numbers and determine that it had enough teeth for us to do the deal. So the numbers came from people who do car washes every single day. And so they are telling us, hey, these trade at 10 times EBITDA. And based on the location, the number of vacuums, the traffic count, the number of people within a 2-mile radius, this is what we're projecting that this will do sales wise. And therefore it's worth this. Does that make sense? So it's all backed. We don't like make them up. It's all backed into, and that's how we came up with it. And I kind of broke that down here. I didn't change the picture, sorry. Okay, so the car wash, 10 times EBITDA. Projected earnings are based on traffic counts, number of vacuums, projected volume, and then who's going to be operating it. So that's why we're not going to operate it, because that's not what we do. But we are going to come in as an operator in order to get favorable financing and literally operate it for a day and sell. Okay. If that's feasible, and you may get to that point and find out, all right, we may need to operate it for a year so we can get a higher return. You make that determination at that time based on what the market is doing. All right, so my offer for the car wash is 36-month hold time. I really don't anticipate it taking 36 months, but I put that in the offer. I explained that to you guys up front because I never want to not exceed your expectations. So if I tell you 36 months and I exit you out before then it's great, right? But so my offer is 36 months, 1.5%, 1.5 times multiple. So what that means is you put 15,000 in, you get 22,500 back in 3 years or less. But really the main thing is I want you to take this ride with me. I want you to get the education. I want you to come up with me to the grand opening, and I want you to understand what it takes to develop a project like this. So I will do quarterly calls, very similar to this. I'm super nerdy, as y'all can tell, and really get in the details. So this is just kind of a surface of what you would expect as one of my investors. And I'm doing it just because I want other people to do this. Like, it can't just be me and Curtis and the other 8 people that we know. Right, Curtis? So we need this next generation of people understanding this, doing this, investing in people. What people like Curtis had to do to raise money 20 years ago is crazy. And I really don't want it to be like that for the next generation. So I want to investor. I want to invest in Da'Vonne and what she's built. I want to make sure that she has quality products. Even if I can only do a small portion of my capital stack, I want her to have access to it. Typically, I would not be able to offer a minimum of 5,000. Yes, I'm still taking a minimum of 5,000, Sebastian. I would not be able to do that unless there was a platform like Vestor. Why? Because Vestor has taken the time to go through the regulations of the SEC and FINRA, right? So that's the big boys, essentially. So I couldn't go out and just take your money off the street. That's not legal, first of all. But this is a way, a platform, a way that people can actually participate and still be protected. It is super duper highly regulated. I think it took her like a year to get it to this point. And so I want to make sure that she succeeds, and it will succeed if she has quality projects, period. So that is my motivation here. That's why I'm doing it. As you can see, most of the capital has been raised already, but I wanted to carve out something that was palatable for people and that they could participate and take this ride. Right now, the deal is focused on the car wash, but as my investors, you guys will be walking through and understanding the entire project with me. So when I meet with you quarterly, we will go through everything that's happened in the last 3 months, and you'll understand where money is moving. We'll be going through leases. I'll be walking you through, okay, we're about to sign this lease. This is what it looks like. This is what you need to look for. This is how you need to understand it. All of that. So that's really my motivation. I like to teach people, and I like to see us win. And although it's not the easiest thing right now I have 22 investors who never call me for any reason. Although it's not the easiest thing to now say, oh, I'm going to bring on a bunch of investors and they're going to have a lot of questions. That's not the easiest thing. Honestly, I still am motivated to do it for the greater good. Y'all with me? All right, I'm done. Are there any questions? Y'all are just great. Y'all just sat there and listened the whole time. I appreciate it. Hey Marissa, thank you so
I
much.
see some questions in the chat.
Okay.
Let's see the questions. It says, are those actual? Wait, did you answer? How did you convince McDonald's to go mid-block?
Yeah, I think we answered all the ones so far.
What about, are these actual numbers of paper for the car wash property number 3?
Yes, I answered that. Oh, you can answer Deidre's question. Can you explain equity crowdfunding in layman terms so we can understand and feel comfortable with the term? So I'm gonna let Da'Vonne take that one.
Yeah, sure. Hold on. Let me, I'll take that one. Wait a minute. Here we go.
Hey, Trudy. Yeah, we'll make the replay available for you guys.
Yeah. Let me see.
The equity on the car wash is a preferred equity. Is that Temple? Temple, is that you, Childs? Oh, that's your cousin. You know, we all
Oh,
connect.
let's see.
Nice to see you. Thank you for coming. Why do
Mm,
malls in certain neighborhoods then sit as zombie? I know it just feel like zombie land there. You know, I'm having a hard time trying to figure out what to do with malls right now. And you see some,
Okay, can you see me?
yeah, we can see you.
Okay.
Yeah. You see some different things happen with malls now. Like you're seeing them take them and add residential to them. But you know, that is something the US
Okay, there we go.
lived on for many decades and it's just changing. Shopping patterns change drastically. So
Okay.
yeah, they have a tough time trying to figure out how to reposition. But honestly, if you find a solution, it's probably low hanging fruit. And okay, go ahead, Devon.
Okay, so I can answer the questions about the so what crowdfunding is, and thank you, Miranda. So what crowdfunding is, it's pretty much or equity crowdfunding. Oh, let me introduce myself, Evan. So thank you all so much for tuning in. My name is Davon Reeves. I am the founder and CEO of Vestor. And so I appreciate you all for tuning in. And what Vestor is, we are a crowdfunding platform and equity.
Uh-oh, she froze.
Okay.
There you are. You're back.
Okay. All right. So essentially, what what equity crowdfunding is, or what crowdfunding is essentially all of us coming together, or people coming in together to invest in smaller amounts, or who are able to invest in smaller amounts. Like Miranda said, she normally doesn't allow folks to come in at 5,000. And so with crowdfunding, you have that opportunity. So in exchange, you know, for crowdfunding, such as like GoFundMe is a type of crowdfunding, but except it's a donation based crowdfunding. Okay. And so with crowdfunding, or with equity based crowdfunding, when you're investing, you're getting in exchange, you're getting equity, right? So you're getting ownership. And when you invest, you're investing in common stock. I saw that there was a question about preferred stock. You won't be getting preferred stock, you'll be getting common stock, and you'll be coming in investing as a limited partner. And so you can go to vestor.com. I'll go ahead and put the site in the chat so that way you all can take a look at it. You go to vestor.com to actually view Miranda's investment opportunity. And so how it works, a you would create you wouldn't have to create an account to view the information. But if you want to invest, then you would have to create an account to view the information. And you'll have to input, you know, some personal information so we can know exactly who's investing. You'll have to sign a subscription agreement. There is no fee for you to invest on anything investor. How we get compensated is through whatever is raised on the crowdfunding platform. So whatever Miranda raises is what we will be compensated with. Like I said, there's no fee. So the copy of the pitch deck is on the site. You can ask any questions to Miranda. There's a previous pitch on there as well. The closing date, I believe, is July 31st. So you'll have time to invest. Some of the ways that you can invest, you can invest using ACH. You can use a credit card up to $5,000, and you can also not ACH, wire. So you would use a wire, and you would use either a credit card to invest. The minimum to invest is 5,000. If you want to invest, you can do more. You can also look at other deals on the site as well. And just sign up to be on our mailing list so you can stay tuned for other opportunities and informational sessions about crowdfunding and about Vestor. So yes, I am here to answer any questions you may have about investing on Vestor. And then Miranda's here to answer any questions about, if you have any specific questions about her deal.
Davon, do you mind sharing the most recent raise that you did with the?
Sure. So we raised about 1.2. The last deal that was on Vestor was a hotel conversion, and we successfully raised. They needed to raise about 1.2 million, and so that was our first raise, and that was done. That was completed in March, and that was a group of Black folks who came on and wanted to buy a, they bought a acquired a Holiday Inn and converted into a Wyndham. And so they came to Vestor to help with their equity raise, and they were successful in the raise. And now we're moving on to Miranda for her raise to invest in a car wash for those who want to invest for commercial real estate. So Vestor is only for commercial real estate. You only see commercial real estate deals. So if you're looking for a marketplace where to invest, come to check us out at vestor.com.
Thank you. I mean, I want to point that out because, you know, here you have this Black family who has put a deal together, and because they come to Vestor, they're able to get in the game, right? So first thing that they educate themselves on a hotel, how to hotel, what the right vendors are. They spent time with Wyndham to understand what Wyndham could offer. So they were prepared. They found a great deal, and they came to Vestor, and now they own a hotel. And so do you understand why Vestor is important to our community?
Yeah, no, I appreciate that. Yeah, and we're Black owned, woman owned. So we are definitely one of the first commercial real estate crowdfunding platform for commercial real estate to include hotels. There are other crowdfunding platforms out there, but they really don't include hotels. So we're one of the first ones, and we're definitely the first Black owned. So proud to be a part of that. And proud to have you all here on the call.
Yes. All right, guys. All right, so we would be investing in the project number 3 car wash for this deal, minimum 5,000, a 3-year return. Yes,
that's correct.
That is correct. Now, there are other ways, and Davon can probably explain this better than me, but if you have your money invested in, say, a 401k or something like that, that's just sitting there passively, there are ways that you can take that and invest it in something like this and get a higher return, and also participate in the education piece as well. Do you want to talk about that, Davon, or should they?
Yeah. So there are some ways. Of course, you want to meet with your financial advisor, CPA, and see which will be the best route for you. But you know, some folks have used, you know, their retirement to invest. You know, like I said, there you can use your credit card up to 5,000 to invest as well. So definitely working with your financial advisor and seeing the different vehicles that you can use, because when you are investing in commercial real estate, a lot of folks invest to take advantage of the tax benefits. So definitely talk to them and see which route would be the best way for you to go so you can invest. I think somebody put in the chat that's the lowest they've seen is I thought I saw it would be 5,000, but oh yeah. Okay, the question is for Vestor. What is the smallest real estate deal you all would do? The smallest we would do is 250,000 to raise. And then it says if we want, you can use a credit card and bank transfer. So you can't do a bank transfer. You could do a wire transfer. So not necessarily an ACH, but you could do a wire, and you could use a credit card. And you wouldn't be owners. You would be limited partners. Is that correct, Miranda? There will be limited partners in a deal. So because they'll have a slither. Will they have a slither equity?
Yes.
Okay. In your deal?
In my deal, yes.
Okay, so you have a limited. So what is the due date for the 5,000 investment? Hey, Trudy, July 31st.
And you can do more than 5 if you want. We have that minimum just because I would like people to get involved, right? But if you want to do more than that, you can. Yay. Y'all have any other questions for me or Davon?
Then we got some coming in. Let's see. What is the due date? Yep, July 31st, 2024 is the due date. And we are open for Miranda's deal, Genesis Development is open for investment. We got another question that says, when is the estimated time to build?
Oh, hey, Portia. Yeah, so actually for the car wash, we are in the entitlement process right now. So we'll have our full plans, and what that includes is your full construction plans. It includes your topography, all the details. That's going to be submitted to the city. Our date to do that is on July 26th, I think. And then once, it depends on if they have comments, if we have to go back and forth and all of that. But we're hoping to begin construction no later than January. And then the time to build a car wash like that is about 12 months. So it will be January of 2026. It should be
when it will open. Okay.
Okay.
Okay. Let's see the question.
You're welcome, Portia. Thank you.
Is there any more hotel investments coming up? Yeah, there will be some hotel investment opportunities. Actually, there's one on the website now. If you go into hotels, there's a hotel investment opportunity.
Yes.
I've truly enjoyed myself, especially seeing this number. I appreciate you both sharing your time and expertise and look forward to more of your success. Well, thank you. We appreciate it. Appreciate you too, Miss Ann.
Thank you.
Yep. So if you have, I put the link in the chat, but I put in there again if you want to take a look at the deal.
Yeah, and if you have questions about the deal specifically, guys, please put them on the Vesta website. As I said, the crowd raise is highly regulated, right? And we want to do everything so that we can be monitored by the SEC and FINRA. So yes, you can reach out to me directly if you want, but if it is a question specifically regarding the deal, we want to follow the rules. We want you to make those requests on the website, and I will answer them there so everyone can see them.
Yeah, awesome. Well, we appreciate you all so much. Thank you, Genesis Development. We appreciate you.
Of course. I love it.
Thank you. Guys. And yes, everyone get a copy. They'll get a copy of both of last night's and tonight's presentation. So you'll have it and it'll be on the site as well. So we thank you all so much.
Thanks, everybody. Thanks for coming. Have a good night.
Thank you. Have a good night.